Well, good morning. So when Jennifer asked me to introduce John Authers, I was truly delighted. And part of the background to that is that I am a longtime reader of the Financial Times, which I still religiously get delivered to my doorstep every morning the old-fashioned way. And of course, John has been for some time truly one of the pillars of that publication. For a number of years, he was the head of the Lex column, which offers insightful, if sometimes somewhat sardonic, commentary on the latest goings-on in financial markets, along with the occasional tip. So just looking at the Lex column from the past week, for which John takes no responsibility, I'm sure, I would tell you that it seems like it may be time to consider gold mining firms and Greek stocks again, but large investment banks are perhaps not quite out of their legal troubles, and therefore it may be worth holding off a little bit on that. And as a securities lawyer, I will add that none of this is investment advice. More to the point, or perhaps more recently, John has been writing for also a few years, since 2006, the Long View column, which, as the title implies, focuses on larger trends in financial markets and indeed in the world economy as a whole, and often brings to that discussion insights not only from economics but from the social sciences and other disciplines more broadly. And it brings a lot of these insights to bear on topics as diverse and important as the Federal Reserve's policy in response to the subprime crisis and its aftermath and its effects on markets, the euro crisis and its consequences for the future of the European economy, and the ongoing travails of emerging markets and how they are affected by many of these policies that are adopted in the major financial centers. And I think this really puts him in an ideal position to tell us about his topic for today, which is how transformations in the structure of financial markets and the nature of ownership of financial assets affect or have implications for the economy as a whole, for how the economy is going to evolve in the future, for the role of governments with respect to markets in the economy, and ultimately the shape of democracy and how it will be affected by these important transformations. And so his topic for today, or his presentation, is Globalization and its Contradictions: Can Markets and Democracy Coexist? Please welcome Mr. John Authers.
Well, thank you very much for that very kind introduction. Thank you very much for giving me the opportunity to come to Montreal. It's been a wonderful experience, both seeing a little of the city in the last couple of days and being at this conference. I have to start. We have an expression in English called "pardon my French" whenever somebody swears. One of the most beautiful things about this city is the depth of the bilingualism. I'm delighted to hear that my title in French is chroniqueur principal de placement. It sounds so much more beautiful in French than it does in English. But very embarrassingly, given the British deserve our reputation for being extremely bad at languages and expecting everybody else to speak English back to us, all we need to do is speak slowly and shout. It's very embarrassing for me that I actually spent 7 years studying French at high school. But then I subsequently served as the FT's bureau chief in Mexico for 4 years, and now every time I try to say something in French, something Spanish comes out. So, je suis désolé. That's about as long a sentence as I can manage. I'm very sorry that this will be a completely Anglophone presentation. Now, Canada's role in financial markets is growing. You're even exporting central bankers these days. And I was delighted, I was very excited to be at Mark Carney's inaugural press conference when he took over as the Bank of England, the first foreigner to run the Bank of England in some 4 centuries of its history, to get some grasp of how Canadian culture is still, unfortunately, little understood. He started by joking that he's succeeding Mervyn King, who had been in the job for more than a decade. He was highly respected. He said it was like following Wayne Gretzky. And the first question he got was, as you can probably depressingly guess, who is Wayne Gretzky? I know who Wayne Gretzky is. I'm not sure that Mark Carney is quite yet the Wayne Gretzky of central bankers, but he's moving there. This is like moving from the Edmonton Oilers to the LA Kings or something like that. We will see. Now, one final point I do need to make, that this is under the overall topic of Canada in the world, and I have to confess that there is not much Canada in this presentation. Broadly speaking, the phrase is "no news is good news." I think that's good. We're going to be looking at the problems of globalization, the problems of markets. Canada has had a central bank that hasn't allowed a property bubble to happen and banks to lend to lots of people who can't repay their debts. It hasn't invaded any countries with invasions that it couldn't afford. It hasn't merged its currencies with other countries. There have been a number of things that Canada hasn't done, which has made it remarkably unnewsworthy, but I think this is probably good news for Canada. Now, what I'd like to talk about is globalization and its contradictions, and particularly how developments in markets have created problems for democracies and nation states. I'm a columnist for the Financial Times. I don't necessarily have a problem with markets per se, but having witnessed the series of bubbles of the last decade or so, witnessed the fallout from them, there are many important issues to discuss that need to be addressed by politicians, and that perhaps, because some of them seem very technical, are not appreciated enough and discussed enough in the public forum. Now, I actually tried to get my ideas about this down in a book which came out a few years ago called The Fearful Rise of Markets. Part of the point that I want to make here is that markets have taken power which was previously exercised by governments and also by banks. So if you go back to the world of the Bretton Woods agreement back in the 60s, foreign exchange was largely, within the capitalist world, which didn't include any of the communist bloc or much of what we now regard as the emerging markets. Foreign exchange was ultimately fixed to the dollar, which was fixed to gold. Commodity prices in large part were fixed. Gold obviously was fixed to the dollar. Oil was a controlled commodity. Interest rates were very directly set by central banks, which in many cases were not independent of governments. They were political decisions where you would put an interest rate and manage the cycle in an economy. And then if you look at the role of banks compared to markets, as you saw the steady deregulation, particularly in the US, that started, I guess, particularly in the 70s and then gained great force under Clinton, you saw many functions that had once been controlled by banks, where a decision was ultimately the decision of one particular human being, one lending officer in a bank, and dispersed instead to market disciplines. So the money market funds tended to supplant checking accounts. High-yield bonds supplanted lending to smaller companies. Commercial paper, the commercial paper market supplanted the job of making short-term loans to bigger companies. And obviously, perhaps the most important, given the crisis that eventually hit in 2007 and 2008, when it comes to mortgage-backed bonds, the role of setting a price, deciding who is going to be good for a loan, that was once the decision of some grey-bearded person working in a building society or a savings and loan, became a job that was ultimately set by the markets. Now, that's not necessarily a bad thing, because market discipline, markets are most of the time quite efficient, but they do tend to overshoot, and as I will demonstrate, because of the steady institutionalizing of the way we make investments, there have been a number of persistent inefficiencies that have entered markets, meaning that they're not the best mechanism sometimes for setting these rates. Now, when it comes to the institutionalization of investments, I think the critical problem is that in many ways, to use the economic jargon, principals have been separated from agents. In other words, in many different areas, people are not dealing with their own money when they're making a decision, they're dealing with somebody else's. It's basic human psychology that if you're dealing with somebody else's money, you will behave very differently from if it's your own money that's at stake. You can see that most clearly again in the mortgage market. At one point, if you made a loan to somebody who was a subprime loan, who didn't look to be a very good bet to pay it back, you were the person who bore the risk that they would default. Under the current system, often lending officers are incentivized to make as many loans as possible because so many banks are keen to buy those portfolios of loans and sell them on the market. You can sell that risk to somebody else. It's not your problem. It can then, in many cases, be packaged and repackaged many times over on the market so that nobody is quite sure who is holding the risk. To draw an analogy with Harry Potter, which I frequently do, given I have a 10-year-old daughter at home. Voldemort, the great wicked wizard in Harry Potter, splits his soul into 7 different pieces called Horcruxes and hides them all around the world so that you can't kill him off. You don't know where he is until you've found all of them. In much the same way, this residue of toxic bad debt got split up and split up and split up so many times that nobody was sure where it was. Nobody was sure if they were holding on to it themselves. Until they had some confidence, it meant that confidence in all securities was compromised. So Harry Potter and the Deathly Hallows very intriguingly came out in 2007, just as the subprime market was crashing. J.K. Rowling, you know, the most successful British author since Shakespeare, also turns out to have a very good grasp of the problems of splitting principals from agents in markets. Now, another critical point is that the way we invest now has created moral hazard, which is another economic term for the concept that you will take much more of a risk if you are confident that you're going to be bailed out. Once you have insurance, you're more likely to take a risk than when you don't. Now, people talk about that most often in regards to bailouts for banks which are too big to fail. If you are JP Morgan or Citibank, you know that you cannot possibly be allowed to fail, which means that you have moral hazard. You know that somebody is going to have to bail you out if you make a mistake. This creates all kinds of fascinating topics for regulation and law professors. It's also present in the way in which fund managers are paid. Mutual funds managers aren't paid to go out and beat the market. They're paid a proportion of the assets they own. So they're basically paid to collect money, to bring in money from other people. When you're in that situation, it's a very popular analogy I've heard more than once on Wall Street to the Serengeti. What you want to do is not do worse than your peers. You don't, and in the same way, if you're a wildebeest on the Serengeti, you do not want to be at the front of the herd or the back of the herd because that's where you're most likely to get chomped by the lion or the cheetah. You want to be in the middle. So what tends to happen is that rather than people going out spotting anomalies in the market, which is what they're supposed to do, that's their job, finding things that will take risks that will go against the herd and make them money in the long term, what they are most wise to do is to see what everybody else is investing in and invest in that because there's safety in numbers. The result is that you get bubbles forming, that money tends to surge into particular directions. You also find, because investing is now dominated by a few particular institutions, everybody frames their thinking in the same way. It's very difficult to be given control of very much money unless you've got an MBA and unless you've got a CFA qualification after that. Everybody, when you come away from a business school, you feel as though you're ready to rule the world. You've been given all these tools, all these models, which have such beautiful, classic simplicity. I can remember one time when I was at business school, the notion that you would be asked, how can you diversify away all the risk from a particular product? How can you measure risk? The problem with the kind of theories that were developed, like anything in economics, they are dominated by the phrase ceteris paribus, all other things being equal. You can produce models which show you what the price of a security should be in a particular set of examples, and you can produce from that very nice, clear mathematical demonstrations of what the price of some particular security should be. But in the real world, ceteris non paribus, things aren't always equal, and people gain overconfidence. If you think you can measure risk, if you think you can put a number on risk, then you begin to think that you can control it. And of course, the very point of risk is that you can't control it. Now, let me show how the world has changed in ways that I think are underappreciated. The growth in institutional fund management, in the concept of people giving money to particular people to go away and invest it, is a surprisingly new one. We've had banking for centuries. We've really only had fund management in the form we recognize it now for a matter of a few decades. This, I suspect, is why markets have begun to behave in such a dangerous and problematic way in the last decade or so. This is the growth of worldwide mutual fund assets. It's in trillions of US dollars. So you can see that the industry is on a scale that's completely different from what existed even 20 years ago. There are good reasons for that. Demographics are changing, the baby boomers are getting older, the emerging world is emerging, and people are investing in a way that they didn't before. So there are reasons why this has happened, but it means we need to look very carefully at how this huge sum of money is actually being controlled and how it's being directed. Now, if we take a look at patterns across the world, you can see that this is a truly global phenomenon, that another $1 trillion is going into funds every year. You can see the effect of the Lehman Brothers crisis of 2008 there rather dramatically, but it only interrupted things for 1 year. And this is a phenomenon that's global. Asian economies are growing, starting to put money away. Now, the critical fact I want to try to get across is how new this is. This is a chart from the US Federal Reserve, the central bank in the US. And what we're looking at here is the ownership of the total market cap of the New York Stock Exchange over time. So if you can't read the scale, it starts in 1955. And it ends in the end of 2009. The blue line there is households. That's other words. That's the proportion of the market that was held by individuals investing in on their own account. And the dark purple area is the money that's controlled by institutions. So you can see half a century ago, basically, the world's money, the stock market was a game for rich people playing with their own money. Now it is a game for large investment institutions playing with other people's money. That's just the ownership. If you looked at the proportion of trading that goes on in any day, how prices are set at the margin, obviously there are many hedge funds that turn over trade many times a day. Their impact on price setting day by day is more or less total. So when we go back over history, look at stock market history, we need to bear in mind that the people who are making the decisions are different, and they have different incentives. As I said, they need to look to travel in herds. They want to try to raise the assets under management. They're not necessarily trying to beat the market, maximize their returns. Now, there's another issue, which is a very problematic one when it comes to how efficiently markets will set prices for countries, which is that as time has gone by, it's become ever more widely understood that it's very difficult to beat the market, and that the costs you incur in even trying to beat the market will often mean that you doom yourself to failure. And that in the long run, you are much better off putting money into a passive fund which just tracks an index and which costs much less to manage. Now, I've written many pieces whenever I do actually try daring to give people a tip, suggesting that indexed investing is the way to go. And it is. This is a classic collective action problem. And as you can see from this chart here, where the top two bars there are exchange-traded funds, which are passively managed, and all other index funds, you can see that since the crisis, we've now reached the point where most new money being invested in the market is being invested passively. Now, at an individual level, that's a completely good idea. At a collective level, it's a very bad idea, because an index fund makes no attempt to question the valuations that are being put there. It will automatically send money where it is to stocks that are already the most expensive, to currencies that are most expensive, and bonds that are most expensive. That's how an index works. So what you will tend to find is that this puts great power in those who actually produce indexes, and it means that the herding tendencies of markets become ever more pronounced. They will tend to amplify whatever situation you have and keep amplifying it until the situation becomes untenable. So why does all of this matter? The classic explanation, the classic free market justification, which is a very good one, is that markets can often enforce necessary discipline on governments. Now, one of the first very big stories I covered at the Financial Times was back in 1992, when we had what has gone down in history as Black Wednesday. It was what ultimately doomed the Conservative Party, who were in power at the time, to some 14 years out of power. We were trying to keep the pound at a stable exchange rate to the rest of the currencies in the European Union. We were plainly thereby very overvalued compared to the German Deutschmark. And so George Soros, who had, before that was not such a famous name, staged a very calculated attack where he, in one fell swoop, having organized lines of credit in banks throughout Europe to be ready to do this, started selling the pound very aggressively against the Deutschmark. The government responded by the markets opened at 9:30, and at 9:45 we heard that interest rates had gone up from 10% to 12%. Seems a very long time ago now that interest rates are zero. Interest rates had gone up from 10% to 12%. The pound continued to fall. I went to lunch. Very few other journalists had not actually avoided cancelling their lunches. And when I got back, I discovered that interest rates had risen from 12% to 15%. So the cost of borrowing had increased by 50% in a matter of hours. Plainly at this point, everybody in the market could see this wasn't credible. No government was going to go through with this. So the selling of the pound continued. And indeed, after the market closed, the Chancellor appeared with a very nervous young aide standing next to him called David Cameron, and announced that Britain's membership of the European monetary system was being suspended. And 20 years later, it's still suspended. What was important about this was obviously a humiliating moment for the government. Does it really have any negative implications for democracy? Well, no, it doesn't. The reason Soros was so confident to attack the pound was because it was plainly being held at an artificial and unhealthy level. The next day, not only did the exchange rate the interest rate come down from 15%, it actually went all the way down to 9%. It got cut further thereafter. and Britain went on a boom that lasted right the way through to 2008. We didn't even have a recession when everybody else did in 2000 and 2001. So Soros provided a market discipline that in many ways did the British a favor. You could make similar arguments about the Mexican tequila crisis, which is similarly about breaking, where the market broke a foreign exchange which had been pegged at an unrealistic level. It created extreme pain for the Mexicans in the short run, but it revealed deep problems with their banking system, which have now been sorted out. And you could also argue that the credit markets in Europe, when they started attacking Greek debt or Spanish debt, were again merely revealing an underlying problem that had to be resolved. However, so there are ways that this isn't necessarily dangerous for democracy if markets help ensure that that governments obey reality. The problem is, and George Soros himself, who was a philosophy major at the London School of Economics, and if you look at some of his recent books, plainly still wishes he had been a philosopher rather than a billionaire hedge fund manager. Soros has this concept of reflexivity, which means that markets can create their own reality. They don't reflect it, they can create it. If markets push up commodity prices, that has a real-world effect. If markets push up currencies, that has an effect on the balance of trades. They can create their own reality. Similarly, when big investment institutions have more weight than governments, this has an impact on democracy. In the Canadian context, Western Ontario, the Ontario Teachers Fund or the Caisse de dépôt strike real fear in the land. Many other sovereign wealth funds around the world, similarly, or large pension funds, are very major actors in economic policy. When you have a system, when you get to a stage where markets have become hopelessly reflexive, then nation state, the whole notion of a nation state or of a democracy becomes somewhat compromised. I'm going to offer you 5 examples from the last 5 years. Let's start with 2008, the crisis year of 2008, and the great bubbles of 2008. Now, this is one of my favorite, when it comes to market trivia questions. What we're looking at here is the price of a barrel of oil relative to the average price of a share in a US bank, as measured by the S&P. This was the year that Lehman went bust. This was the year, in September of that year, this was the year that bank stocks turned out to be a terrible investment. And you can see that at one point, oil had appreciated by more than 200% relative to banks. So if you had bought a bank share, if you'd borrowed a bank share and then sold it and used that money to buy a barrel of oil, you would have been sitting on a profit of 200% in 6 months. And yet, if you'd not taken your profit and carried on with it until the end of the year, one of the little remembered facts was that oil actually performed worse for the great financial crisis year of 2008 than the average US bank did. Let me try to explain how this happened and why this is a problem for democracy. Entering 2008, it was plain that the US banking system was in extreme trouble. To anybody who knew anything about the subprime market, it was obvious that US banks were in deep shtuck. The response was plainly going to have to be that the Federal Reserve would cut interest rates as far as they could to relieve the pressure on the banks. When you cut interest rates, that means that you get less return on your investments. In the States, it means that there's more risk of inflation in dollar terms. How do you protect yourself against that? And how do you also second-guess the fact that there's going to be money flowing out of the US as people flee the conditions, you buy hard assets that will retain their value. What's the hardest asset out there? Oil, even more so than gold in many ways. So a lot of people very deliberately sold American banks and bought oil, and they kept buying oil. Now, there are two issues with this. The first is that after a certain point, you realize that you destroy your own logic. You're arguing that there's going to be a terrible recession in the US, that the banks are going to be failing, that they're going to have to cut their interest rates to nothing. But somehow or other, the price of oil is going to go through the roof, even though the US has suddenly got a lot poorer and has much less money to spend on oil, which is plainly mutually contradictory, must fail under its own logic after a certain point. The second point is that when oil increases in value, it's reflexive. It changes the economic reality. It moves, if the price of oil is an extremely important part of any inflation basket, in its own right, it pushes up inflation. So what you saw in Europe, European banks were probably even more awful shape than American banks. Very serious credit crisis coming down the pike. The European central bank saw the way oil was going up. They got scared that actually they were going to see inflation. And so in July of 2008, 2 months before Lehman went bust and we had the biggest financial crisis in living memory, the European Central Bank actually raised interest rates, the exact opposite of what they should have done. They then also announced, they also announced when they did that, however, that they were not going to be cutting rates, raising rates again next time, the following month. And many people, I think, at that point took that as the trigger for realizing this has gone too far. We need to get out of oil. And so on Bastille Day, you see that peak, July the 14th, you see that peak, and then everybody charges out of oil. But the problem is, and remains, that you've set it, that economic policy making in these conditions becomes impossible because a set of mutually contradictory conditions have been set by the markets. You reach a point where we're about to have a financial crisis. We're facing the risk of bank collapses, which is terribly deflationary, and yet we appear to be in a world where inflation is rising. This is classic reflexivity. And just to show you how different markets become intertwined with each other, this is the price of oil during the crisis year of 2008 compared to the exchange rate of the dollar against the euro. The reason you see quite such a close relationship until right at the end of the year when the crisis had hit, the reason you see such a close relationship is that when oil producers sell oil, they get paid in dollars, they get nervous about having so much in dollars, and they will automatically diversify by buying euros. So what that means is the higher the price of oil, the more euros are being bought compared to dollars. Therefore, the higher the price of oil, the weaker the dollar, and the stronger the euro. And this was another problem for the European Central Bank. They had an unnaturally strong currency, and yet they tried to raise rates, which is again the opposite of what you would normally do, led to panic in the markets, to the liquidation of many positions, which may have, I think Lehman was doomed whichever way, but may certainly contributed to the mayhem that we ultimately had. Now, let me a second example of how this came to affect markets. This was I was very embarrassed to have this pointed out to me by an intern early in 2007 who had a comment made to him by an analyst that the S&P 500, which is an index of the 500 biggest stocks in the US, share prices, seem to move exactly in line with the exchange rate of the euro against the yen. Now, think of the amount of trade that happens between Europe and Japan, the number of different decisions that are made each day. Think of the number of different reasons people would buy or sell any one of the 500 stocks in the US stock market. And yes, as you can see, they basically became the same thing. There was a point in 2007 when it became a matter of a joke in the office that we would have two Bloomberg screens open, one with the yen per euro on it and one with the S&P 500. And they would literally move together minutes by minute throughout the day. Now, what was going on here was a concept called the carry trade. Many fund managers look to diversify. They look to find risks that are different from the ones they're already taking. So rather than stay in stocks, they started playing in the foreign exchange market. There's a very interesting trade you can do in foreign exchange, which is to borrow in a currency with a low interest rate. And in the case of the yen, Japan has had virtually zero interest rates for a long time, and to park your money in a currency with a higher exchange rate, which in this case, if we just look at the euro has the European Central Bank was a tougher central bank. You had higher rates. When you are feeling confident, you keep putting more money into the carry trade. When either your S&P bet or your carry trade loses money, then you fund it by taking money off the other one. The ultimate result is that the two trades went absolutely hand in hand. And what does that tell you about how efficiently either of those markets were being priced? I think at one point it was more than 90% of variation in the S&P could be explained by variation in the exchange rate of the yen against the euro and vice versa. Plainly, it's very difficult to make economic policy when conditions have created such a bizarre situation. Now, this also leads to the concept of currency wars. This is my third example, and let's particularly take a look at Brazil, because their finance minister Guido Mantega very publicly complained about currency wars. Now, the problem that Brazil has, because it's got high inflation and because it has a lot of commodities that it exports to China, is that it is seen as having an inflation problem and therefore has very high interest rates, which makes it an extremely promising country to park your money. If, however, what it meant though was that there was a lot of hot money moving into Brazil, which was always liable, because the currency market is a particularly liquid one, to leave in a hurry if people got worried about things elsewhere in their portfolio. They would just take their profits and get out. So what we are looking at here, you can see these two lines are virtually indistinguishable for the year of 2008. The red line is the Brazilian real against the dollar. As it goes higher, that means that's more reals to the dollar, it means the real is weakening. The blue line is the VIX volatility index, which is a fairly technical measure which measures how much people are prepared to pay in the options market to guard against future falls in the stock market. It's often referred to as the fear index. When it rises, it means people are getting more nervous about where the US stock market is going. So basically, if you wanted to predict where the exchange rate of the Brazilian real, all you needed to know was how stock traders were feeling on the floor of the New York Stock Exchange. There was almost no relevance to any other. The endemic factors to Brazil were of almost no relevance. This whole concept is often referred to as risk-on, risk-off trading. All securities are either relatively high risk or relatively low risk. If you're feeling confident one day, it's risk-on. If you're feeling nervous, it's risk-off. How exactly, you can see why Brazilian finance ministers would get very aggrieved about this situation. It's very difficult to set economic policy when your exchange rate is ultimately being guided by the animal spirits of people trading stocks in New York. Now, one final example is everything moved together as the crisis reached a head in 2008. It was the most truly global financial crisis we've had. So it became almost a parlor game to spot these ridiculous correlations. One of those is Hungary from 1997 to 2008, and the other is Korea. Of course, we all know that Hungary and Korea are very, very similar economies. The mind boggles, really. So one of them has Samsung and the other one doesn't, and one of them just had a crisis entering this period and the other one didn't, and if you can work out which was which, well done. Doesn't make it easy to set economic policy in either Korea or Hungary. Now, my favorite demonstration of how reflexive things got, how markets moved to a point of view where they were reflecting a reality that just didn't exist. It's a very interesting research that was produced by a guy called Rob Arnett at Research Affiliates. He's an academic who now manages money. They have historical research going back to before the war, where they look at the progress of 16 different asset classes. So this goes from 1-month treasury bills through gold to high-yield debt. It's a range of different assets. And generally speaking, and cash and deposit accounts. Generally speaking, when something loses value, it loses value with respect to something else. When you take money out of somewhere, that money generally has to go somewhere. So the previous record for the most number of asset classes to fall in any 1-2-month period was when long-term capital management, the big hedge fund, imploded in the autumn of 1998. And at that point, 11 separate asset classes managed to fall. In the 2 months of Lehman, September and October, all 16 asset classes managed to lose simultaneously. 20% net fall. So basically, 20% of value was written off world markets that shouldn't have existed in the first place. But it's very difficult. It's very difficult indeed for every single one of those assets to fall together. And they did. This is what is known as, again, quoting George Soros, this is a super bubble. Now, let me go on to a fourth example of how the way markets work creates great problems for policy, for democratic governance. China, as we all know, is growing very fast. You hear or did at one point hear lots of complaints in the States that China was deliberately stockpiling American debt, that it was China buying American bonds that kept American interest rates too low during the last decade. But in many ways, it's inevitable that China is going to accumulate reserves while it is growing so fast and making that growth through exports, through selling things and generating reserves. Now, again, what you're seeing in this chart, the red bars is the change in Chinese total foreign exchange reserves. And then the blue line is the exchange rate of the dollar against the euro. When the line goes up, that means the euro is gaining against the dollar. So you can see that briefly during the crisis, the Chinese almost stopped accumulating reserves altogether. You can see that at the beginning of 2009. And you can see that then in the last year or two that they've become much less regular. I'm afraid this chart finishes about a year ago. They've become less regular accumulators of reserves. What is fascinating, again, it's very similar to the dynamic I took you through with oil. China makes its exports, makes its profits, gets its reserves, creates these reserves which tend to be in dollars, doesn't want to be overexposed to the dollar, particularly given that people in Congress seem to think it's a good idea to threaten to default on American debt every so often. So they regularly diversify into euros. The higher Chinese reserve accumulation in any period, also you would expect the euro to gain against the dollar. Now, this is important because obviously the Eurozone is in crisis, and one of the easiest ways to relieve the pressure on the Eurozone, to relieve the pressure on countries like Spain and Italy on the periphery of Europe, would be to have a much cheaper euro. That would make it easier for them to, it's a classic devaluation way, but it's a way to allow that, make it easier for them to sell their exports. However, what you've seen is one of the great mysteries is that even though at one point, well, at several points there's been concern that the euro might even cease to exist as a currency, it's actually continued to sell really rather well, and it's maintained its value through most of the crisis, making it that much harder for Europe to see its way through the recession. That's probably because of Chinese reserve accumulation more than any other single factor. Now, it's not just, to some extent you could look at this almost as the Archimedes principle. In globalized markets, if China is that big, it displaces a certain amount of fluid, and that fluid will be displaced elsewhere in the global financial system with consequences. Now, it's not just the People's Bank of China we need to talk about. We also need to see the effect of the Fed. So the Federal Reserve has for many years been conducting a policy of known as QE, which is short for quantitative easing, which is basically buying bonds so that you push down the yield on those bonds and you thereby reduce the overall interest rates in the economy. Now, that's not something that there are many, many reasons to be nervous about doing this. The Fed itself doesn't really like doing it. And so you saw earlier in the spring of this year, Ben Bernanke, the chairman of the Fed, started talking about tapering, the idea that they would start tapering off the amount of bonds that they bought each month. He started saying that just in early May. And the effect was quite dramatic. It meant that people charged out of 10-year bonds, that the interest rate, the yield on 10-year bonds went up very sharply. And at the same time, what you're looking at there is how the stocks of emerging market countries that were running a trade deficit fared. And you can see there was an almost automatic one-for-one response that once the Fed said that it was going to start tapering off, people immediately started selling any emerging market that appeared to be in danger, that appeared to be running a trade deficit. This would mean if the rates were going to go up in the US that there would be less American money flowing towards these emerging markets. This meant that it was time to get out of them. If you want to see how that translated in terms of currencies. Again, you can see very, very clearly on this chart when Ben Bernanke started talking about tapering, from the effect that this had on the Indian and the Brazilian currencies, and also to an extent the Indonesian rupiah. This was a very serious problem, which to some extent forced the Fed to decide in September, causing great shocks around the market, not to taper, to start tapering off QE after all. It will have to do that. The big idea at the moment is that Janet Yellen, the likely next head of the Fed, is going to try to taper off bond support, but keep rates low by forward guidance, by effectively promising that rates are going to stay very low for a long time into the future. Whether that will work remains to be seen. Mark Carney's debut in Britain has been, he is a strong believer in the use of forward guidance to have exactly this kind of effect. But we've already seen some of the problems in the UK because he arrived just as the Treasury Department had decided to very aggressively stimulate the UK housing market, with the result that the UK economy suddenly started sparking into life much more than people had anticipated. So he had set conditions: we will not be raising rates until these conditions have been met, thinking that these were conditions that wouldn't have a hope of being met in some years. And it now looks as though, judging by his own forward guidance, he may be required to start tightening very soon. So we've seen what the problems of forward guidance can be. Somehow or other, the Fed wants to stop propping up markets. Somehow or other, it's got to do that without causing an emerging market crisis. There's plainly a great risk that that will happen. So those are my best examples of how, in all of these cases, you have markets that are, in many ways, being driven by, creating their own reality, being driven by technical market factors rather than by any form of economic fundamentals, and they make the setting of economic policy very, very difficult, particularly for all those countries that aren't the US or China. Now, so what to do about it? I've got one slide on what to do about it because it's an incredibly difficult problem. Ultimately, plainly, there has to be a very great risk. There is a futurologist in the room, I believe. There plainly has to be a risk that if you carry on having incidents like this, governments will be tempted to roll back markets, that we will attempt to see controlled exchange rates, controlled commodity prices, etc. It's very, very difficult to put Pandora back in the box. I would hope that what this will instead do, the risk that we would see as stepping back from market disciplines, is that this will be a spur for actually trying to deal with some of these apparently technical problems, which are in fact very serious. Some of the ideas, there's the Tobin tax, which is being experimented with in Europe, is the idea that you pay a tiny tax every time you make a transaction. It means that the incredible churning of markets, particularly in foreign exchange, no longer becomes economic. To give you some indication of that, the total volume of trades in the foreign exchange market is now past $1 quadrillion per year. That's a 1 followed by 15 zeros. It's a lot bigger than the GDP of the world. Can't be necessary to trade quite that often. I also think you need to shake up fund managers' incentives so that they're no longer paid according to assets under management. You need to give them an incentive to actually make some money or get out. I think banks are riven by problems with principal and agent splits. It's not so long since investment banking was dominated by partnerships, by people who took the money if they gained, but also stood to be personally bankrupted if they went wrong. I'm also a believer in returning to a Glass-Steagall system where investment banks underwriting securities and trading are kept separate from commercial banks. There are various different versions of this going around, perhaps not with enough urgency. Again, it dramatically reduces the amounts of money available for speculation. I think we need new models on how to diversify, which don't merely look at one particular asset class versus another. What we discovered in the last few years was that you didn't have separate investments diversified in different ways by having some money in commodities, some money in foreign exchange, some money in stocks, and some money in bonds. All of those markets would predictably move in the same direction if the same risk occurred. Rather than diversifying, you had instead taken the same bet many times over in different markets. That's how you had the bizarre correlations that made it so difficult to set policy during the crisis of 2008. And plainly, we need to tighten financial regulation. Why did Canada avoid a crisis? Why did England decide that it wanted to import a Canadian central banker? Probably because Canada has tighter banking regulation than the rest of the world. So I'd briefly like to conclude. I've opened a lot of questions without giving a lot of answers. I'll be happy to take a lot of questions. I'd like to conclude quickly with two things. First of all, ultimately, don't get me too wrong, that's sort of borrowing from Churchill, who once said that democracy is the worst form of government except for all the others. And I think much the same can be said about markets. It's the worst way to allocate capital apart from all the others that have been tried. I'm not advocating going back to government planning. It tends not to work. What I am advocating is that the development of the way in which we invest has really diminished markets' effectiveness in allocating money, and it should become a much more important priority to fix that, because it has real painful world consequences. And finally, borrowing from making a second star appearance after Cleo Pascal's wonderful but rather scary presentation yet. I know a lot of this presentation was rather scary and rather downbeat. So there is Cleo Pascal's puppy once more, which I stole. Very, very cute puppy though. And on that note, thank you. Merci.
Hi, Joseph Heath, Trudeau Fellow. So we've been hearing about Tobin tax for decades, and so it's interesting that attempts are being made to implement one. So this is just totally for my own personal interest, but hopefully other people are interested. So I'd be really, really interested in hearing more about how it is implemented. How do you collect it? How do you keep track of it? And then how do you avoid compliance problems with it?
These are all, I'm afraid to say, extremely pertinent questions. I actually take a view which is, and I did when I was editing the Lex column, a view that's different from the Financial Times as a whole. The view of the Financial Times is that even if a Tobin tax were workable, it would be a bad idea. I actually think that throwing a little sand in the wheels of the markets, which I think was Tobin's phrase, would be a good idea if it can be made to work. It's very difficult to see how it can be made to work, how you can eliminate the free rider problem, how you would avoid some jurisdiction getting in the way. That being said, we do have a very interesting experiment underway, because it does look as though the financial transaction tax is going to happen in Europe. It's possible that you will find ways that it can be implemented. Particularly in stocks, where it might be easier to put limits on the different venues it takes place, and where you have the particularly egregious version of high frequency trading, which isn't really about trading at all or making any bets on the market. It's about exploiting the mechanism of the market, of seeing what the difference between the bid and the offer price is, and taking some of that spread for yourself. I was very alarmed once. I was at an exchange where I discovered there was competition between different banks for whose server would be closest to the exchange's server, because the picoseconds of difference it would take for a signal to go along a physically shorter cable made a difference to them. I can see no benefit in that. I think there may be ways, if you've put a limit on the number of different jurisdictions in which you can sell stocks, it's conceivable that you could come up with a version that strongly limits that trading. I don't see any negative effects for free markets from eliminating quite such extreme forms of high frequency trading. But the basic answer to your question is it's very difficult to see how it can be implemented. At least people are now going to try, and we'll see what works.
Jennifer Clapp, Trudeau Fellow. I have a comment and a question. The comment, I really appreciated your point about the separation between principals and agents and more risky behavior, but I think you could also perhaps, and I know you didn't have time to go through this, but the principals and the agents are both separated, again, from the real world effects. And I think we've seen that in a number of areas, and I thought you gave great examples, but I wondered, and I wanted to hear your opinion on a potential sixth example, which is investment in commodity investment funds and impacts on not just commodity prices as a abstract concept, but also food prices, which has definite real-world impacts. And I think it's an interesting case because the banks and investors, investment funds are so adamant that what they're doing is not affecting world food prices. And it's interesting, and a follow-up is, what is your, are you optimistic about financial regulation? The sort of last bullet point on your last slide. And I've been following the Commodity Futures Trade Commission efforts to put position limits back in place on commodity investments. And as you probably know, they came up with a rule in 2011, and then they were sued by the International Swaps and Derivatives Association for not proving that they were necessary or adequate means of regulation. And they've just put a new rule in a couple of weeks ago, and I'm curious if you think that this will go through, and do you think it will make a difference? Because as you said, putting the genie back in the bottle is a little bit difficult. So I'd be really glad to hear your comments on those issues.
I mean, on yes, it would have been that would have been a very valid sixth example, and perhaps it would have been a sensible one for me to choose, given how important commodity markets are to Canada. I find that the circumstantial evidence very strong indeed that that the expansion into commodities and the treatment of commodities as though they were something you could hold like a stock must have had some effect in the great rise in commodity prices that you saw leading into 2008. That there was a lot of academic research showing that they had this magical propensity of being strong but uncorrelated returns. So you could reduce the risk in your portfolio by buying some commodities as well. And you had the introduction of exchange-traded notes, which made it very much easier to buy on a passive basis into the commodity market and just hold it. I find it hard to believe that the huge growth in influx of funds into commodities that sparked wasn't a large part behind. I did give you the example of oil, but also metals. On food, there are some food markets which are not as financialized as others, and you do see, like last year, there was a very frightening spike in commodity prices, which corrected itself. I get the impression, and was driven apparently by real-world factors. I have the impression that food prices are probably not as much driven by financial factors as other commodities. I haven't looked into it in great detail of late. In terms of regulation in the CFTC, plainly this is something that position limits are very important. You need to put some kind of a limit on the speculation there. The way in which the CFTC has really differed from other agencies has been quite fascinating. I would imagine that it would make a difference.
Thank you very much. Thank you for this powerful demonstration of the financiarization of our economy. Something that I would like to highlight in terms of this connection and that I would like to hear you about is the point about the disconnection with the social and environmental cost of this financiarization. Typically, we see that when a corporation lay off people, the value of their stock get higher the day after. So there's no connection between employment and this wealth that is being artificially created. So that's for the social impact. And when you look at environmental impact, for example, when the prices of oil goes higher up, there's more pressure to get oil from sources that are more damaging, that creates more impact on the environment. So I was wondering what kind of mechanism you would see that would help to reconnect the benefit, the financial benefit with the very often high social and environmental cost. And do you think that, for example, the triple bottom line approach that has been pushed forward by a certain organization asking corporations not only to give result on their financial benefit, but also on their environmental and social cost would be among the solution if it was mandatory, not only voluntary? Thank you.
Okay, I think my response to this question might be a little bit more like what you would expect from a Financial Times investment columnist. When it comes to unemployment and the impact of layoffs, you need to distinguish between the short term and the long term. It is certainly the case that in the short term, the interests of companies and their shareholders are not necessarily the same as the interests of the economy as a whole, and can even be completely divergent. So yes, it's true. If the value you derive from a company is derived from its earnings, which is its revenues minus its costs, if it manages to cut costs drastically by laying off a bunch of people in a way that won't affect its revenues, then it's just become worth more, so the stock will go up. What you do find, however, is that, again, when markets are working properly, there are natural forms of correction here. This is where markets can work properly or perform their necessary usual task, which is to force companies towards efficiency, to boost productivity, and ultimately thereby create more growth. Once you do create more growth, then the bargaining power of labor increases, profit margins come down, and people get happier again. In the long term, there isn't necessarily the same disjunction, that is to say, between the interests of the company and the interests of the economy and society. That being said, it is a very extreme situation we have at the moment, where the US economy in particular has really done nothing since the crisis, and yet the stock market is at record highs. And yes, there are very interesting questions about how long this situation can be sustained without getting some kind of a social response. When it comes to oil, you're completely right that when the price of oil goes up, that increases interest in methods of oil, of extracting oil, which are even more environmentally unfriendly. So the great boom in trying to exploit the Alberta oil sands dates back from the great charge up in oil prices in the middle of the last decade. And fracking, obviously, has a lot to do with the rise in oil prices. However, a high price of oil also very dramatically increases the interest and the potential profitability of investing in environmentally friendly forms of energy. So you saw, about a decade ago, you saw a huge boom in investment in ethanol, because ethanol production, which wouldn't have been economic when oil was $20 a barrel, became very interesting indeed when oil was over $100 a barrel. Solar energy and the growth in wind farms also have a lot to do with the signal that the market sends you when it puts up the price of oil. Also, I would make the point that it's a little remembered boom now, but the ethanol boom, where you saw ethanol futures rise, I think it was about 300% or 400% in a matter of months. To some extent, it was market discipline that helped demonstrate that ethanol wasn't the answer that it appeared to be. It was one of the things that Al Gore had recommended in his documentary. And but when the price went up that sharply, it meant that lots of farmers throughout the Midwest converted production to, I think it was corn that you used to create ethanol. I'm trying to remember the details now. There was one point when I needed to know an awful lot about ethanol production. That meant that they diverted production away from soybeans. There was a big demand for soybeans from China anyway, because they needed to feed their pigs. The soybean price went through the roof, and we realized that moving to ethanol production wasn't actually going to help the world's ultimate energy problems, our ultimate constraints on our natural resources, because it was just going to create a different problem. So ultimately, certainly when you have the kind of situation that I was talking about, where the oil price stays too high for too long, it can be very dangerous, but it does, to be fair, also provide incentives for alternative energy. I spend a lot of time being sent prospectuses for new alternative energy funds. Providing the oil price doesn't bear some relation to the underlying supply and demand in the world economy, a high oil price can actually stimulate correct behavior, or can actually stimulate us towards finding a better mix of energy supply.
Hi, Alex Gabriela from Science and Policy Exchange. It was a great talk. Most of the things you were mentioning, though, were on-balance sheet transactions. You didn't really mention that much about off-balance sheet transactions, specifically, the shadow banking system. I was reading a report actually from the FSB just published last week talking about how now certain banks have already been engaging in this for a while, but it's becoming more broadly accepted. Self-securitization, for instance. And I'm also thinking, the London repo market is not really regulated, and now with, keeping the global, globalization in mind, as companies have subsidiaries in London, from Canada, they can easily transfer a certain number of their assets in London to increase their leverage, therefore, increasing the likelihood of another Lehman-like event. So how would you obviously mentioned a new Glass-Steagall, perhaps, might be able to address these issues and separate the regular banks from the trading entities. But how much can regulators truly be proactive, and instead of just continuously playing catch up with the latest, financial assets or investment vehicles?
Well, it's very difficult. It's very difficult not to end up solving the last crisis and waiting. The human ingenuity is such that people will find a new way to do these things. The growth that you're seeing in shadow banking is the shadow banking that emerged as of 07-08 and then collapsed hasn't come back, broadly speaking. Collateralized debt obligations, I just thought, for an audience of people who were largely non-economists, I really didn't think I was going to try to explain what collateralized debt obligations were. I'm very happy not to try to, and I'm sure you're happy not to listen to an explanation. Anyway, the forms of shadow banking that led to overload in 07 and 08 don't seem to have come back. But you're quite right. What happens instead is that people find new ways of doing this. And I think I heard you say that if you're talking about REITs, which is real estate investment trust, those have traditionally been a tax-efficient way to own a building, and now they're being turned into financial instruments that people are buying up all kinds of mortgage-backed bonds and so on. It's very difficult for regulators to be proactive without stamping out a lot of innovation. I mean, certainly in the case of the REITs market, I mean, the FT, well, to our credit, had a front-page splash about this only a week ago. Plainly, there is a need for new regulation. That there needs now that those entities are being used for a purpose that's very different from what was originally conceived. They need to be regulated differently. In terms of banking regulation, yes, we've had the experience of how much was held off balance sheet in CIVs and CDOs and the rest, and how that nearly brought down the likes of Citigroup. Banking regulation has to be much sharper at spotting that. That being said, it's not that impossible. We are sitting here in Canada, where various Canadian banks have steadily made inroads into the States to the extent they're being allowed to by their regulators, because they are so much stronger. It's not that difficult. It can't be that difficult to put a lid on it if you really want to, and if you don't allow the banking lobby to get too strong in your political system.
John, yeah, I'm Patrick Holditch. I'm the British Consul General here in Montreal, but I'm not asking an officially inspired question. Or on the other hand, I don't want to curtail my career too rapidly either, so I'll couch it in diplomatic terms. You talk, just looking at a broader picture, you talk about governments and markets like they're sort of are very sort of separate actors. But there are institutions and individuals which actually bring them together. And I thought one critique you might have of what led up to the financial crisis was that governments and certainly the financial services industry was a bit too close, that there wasn't a sufficient degree of objectivity and distance in how governments approach financial services, so that one doesn't necessarily have to have more radical measures, but just a healthy degree of distance to allow for a more sort of democratic political influence and appraisal of one of the sectors which is, key for some economies. So I just wondered if you could develop that idea.
Well, I would agree with it, but I mean, you have the particular issue that it's not just a question of gaining some distance. You actually need to bring back safeguards and structures that were there before and were deliberately taken away because they were thought not to be a good idea, such as arguably a Glass-Steagall split. I mean, in the US, until the 90s had dramatically more conservative banking regulations than anybody else, with the result that they had a very impressively stable economy for a long time. In the case of, I was covered the great era of deregulation in the 90s. Did it really make sense to have a bar on interstate banking so that that US banks could only exist in one state? Well, did it really make sense to have quite so many American banks? There were over 10,000 US banks, which far, far, far less concentrated system than Canada or the UK or any remotely comparable country. Maybe it didn't make sense to have quite such strong limits as they did, but they basically removed any control over the consolidation of the industry. Part of the problem you now have, this is a problem that happened in Europe a long time ago because there was you could almost call it a crony capitalist desire to create national champions, is that they allowed their banks to get far too big, and that's a big part of the Eurozone crisis. The German and Spanish and Italian and French banks, as a proportion of GDP, their assets are far, far, far bigger than American ones are. To an extent that not only are they too big to fail, but they're plainly too big to save. That the host governments couldn't possibly save them if they wanted to. Same extent you have that with the UK. So it's difficult to regain that distance without, in some way or another, making those institutions smaller. And this is, I mean, there's an analogy with a suicide bomber with a waistcoat full of explosive. There's a good analogy between that and the way that banks have carried on their negotiations. It's just, if you're really going to force us to split up now when the economy is so weak, everything's going to blow up. And it's been quite an effective lobbying technique, because there would be very many risks involved in taking large institutions and splitting them up. You will get unforeseen consequences, just as you've had all the unforeseen consequences I was talking about in my talk from the growth of markets. So it's a very risky thing to get from here to there, but that's what you really need to do, is to move back to this more conservative structure where there were smaller banks. Each individual bank could be allowed to fail. That you didn't have this system where there were really only a few players making decisions, and you ended up with the kind of herding I was talking about. I'm not saying there are easy answers. It's very, very difficult to get from here back to there.
Thanks.
Hi, I'm Alison Render. I'm a law student at McGill. My question was, you talked about passive investment funds, and in Canada we've had a lot of talk about active investment funds, those that have the resources to take a long-term view and get involved in corporate governance, particularly pension funds like the CPP and the Teachers Fund. I was wondering what sort of level of clout do these more active funds have, and is there a way for them to kind of be a counterweight to some of these sort of trends that you were talking about in your speech?
Yes. Just in terms of the lingo, most funds are still active, i.e. they're not just merely passively matching an index. Only a fairly small proportion would claim to be activist, i.e. mixing it with boards, trying to get CEOs fired, trying to force sell-offs and so on. That tends to be, yes, the big Canadian pension funds are really quite, inspire fear abroad. So does CalPERS in California, so does some big activist hedge funds. My best guess, I just didn't go into this because I didn't want to get too wonky in this forum. I think probably the best solution in the very long term is that you have even more money that's managed passively, and that you have a barbell, that there is that there is nothing in between. Either you are paying the smallest amount of money possible for economies of scale, buying just blanket exposure to the market, or you are buying an investment which has no benchmark to the market at all. It's simply aiming to maximize return, and it's going out there and it's saying, look, this company is atrociously managed. We're going to go in there and we're going to force them to fire the CEO and sell off this division and buy this and create value, spot inefficiencies. And providing you have the right incentives on each person, such a model might begin to work. What you have at the moment is a very big floppy middle of funds that charge you a lot of money to attempt to beat the market, but don't actually make a real attempt to do so, but simply amplify the problems of herding that I was discussing. What I would prefer to say, for those who do economics, it's the idea of alpha and beta. Beta is your direct exposure to the market, and alpha is what you can generate above or below the market by your own clever ideas. Some funds should be beta and should just be as cheap as possible, and some funds should be alpha and should make as much money as possible and charge according to how much money they make for people and go out of business when they fail to. That would, I hope, be the best model. We're still quite a long way from that. But yes, your point is extremely well taken. And it also deals with the problem we have that it's a collective action problem. For any one individual, if you did want to ask my investment advice, unless you're extremely rich, you should just put all your money into passive index funds. It's plainly a better bet than anything else. Do I want absolutely everybody to do that? No, because then our markets would be completely, utterly inefficient. Nobody would be setting prices at all. Nobody would be paying any attention to what was too expensive and what was too cheap. So it's a classic problem of collective action, and which has to be dealt with. And unfortunately, it gets into very apparently dweeby, technical, nerdy thickets trying to sort this out, but it's in fact a fundamental problem that's getting in the way of capitalism working.
I will use or abuse my moderator's prerogative to ask one last question. It seems to me that one theme that recurs in a lot of the questions that have been asked and in the presentation.
I can't hear you.
Oh. I'm sorry. It seems to me that a theme that recurs in a lot of the problems you addressed in your presentation and in a lot of the questions is that a lot of the policies that might help, as you mentioned, things like a potential Tobin tax, like restrictions on bank size or on bank activities, or many other policy options that are out there, would be very difficult or impossible to implement in a single jurisdiction on a unilateral basis. And yet, and this is something that I've studied for some time, if you compare what exists today in terms of intergovernmental cooperation with respect to financial regulation and aspects of the financial markets, and you compare it to other aspects like international trade or international environmental agreements and so on, you have a much more informal, a much less legalized and a much, if one were to put that way, a much weaker framework compared to these areas. You have the G20 that provides general guidance at a very high political level. You have some degree of cooperation among national regulators, but they're very hesitant to promise anything because they, for understandable reasons, they don't really control the domestic politics of trying to implement policies. So do you think we might see a growth of more substantial international cooperation on this in the future, or does the fact that this does not exist make a lot of potential policy proposals very difficult or hopeless in terms of actually implementing them?
Well, on the latter point, yes, it's a real problem with free riders. We've had the, as a British person, I'm very embarrassed that the, in the wake of Exxon and WorldCom, very embarrassing scandals for American corporate governance. You had the Sarbanes-Oxley legislation, which made it that much more costly to run a company, to trade in the US. And London, there was one very senior London broker said that he wanted to erect statues to Sarbanes and Oxley outside the London Stock Exchange because of all the business this was going to drive to London. And London, of course, is now, you know, if you look at what's on the FTSE 100, we have, you know, Indonesian copper miners and Kazakh miners who we've become this sort of light regulation. It makes money for London, but in the process, it attracts elements that we ought to be very nervous about attracting. So there's always a very difficult problem getting coordination because different jurisdictions have an interest in trying to be the one jurisdiction with lighter regulation than the rest. I do think it's very interesting. You mentioned the G20. The G20, in the darkest days of 08 and 09, did get its act together and became quite a startling forum for actually making a few necessary changes. It needed the crisis to make that work. Ultimately, it's possible that we could see something similar again. I think that's necessary, but it's a very difficult situation to arise. And again, in terms of the conflict between markets and democracy, you need to make sure that the people putting restrictions on markets, in principle, it's a dangerous thing to be doing. Markets are extremely useful things for pricing capital, for allocating goods. It's very difficult to do better than them in normal circumstances. You've got to make sure that when those changes are made, they have real democratic legitimacy.
Well, thank you very much.
Thank you.
So that concludes our discussion. Please join me in thanking John Authers for joining us.